Thanks, Toby. Yes, this is a major asset class, fixed interest we're talking about, and the title Income with Purpose has got a range of meanings, and I think we're fortunate to have Bill Bovingdon to speak on the topic. He's Investment Director at Australian Ethical, and what's important, he's a highly experienced fund manager, over 35 years experience, so he's seen a wide range of market cycles. So Bill's going to give a short presentation, unpack the topic, and then I'll ask a few questions and then open to the audience for questions. So in the interest of time, I'll just ask Bill to come up and commence his presentation. Thanks, Bill.
Thanks, Nigel. Thank you for that very kind introduction, and not being too specific about how many years I've been managing fixed income. So thanks, Nigel. Look, I'm really happy to be here talking to you all today, and particularly about two topics that I'm very much passionate about, and that is fixed income and working for an organisation like Australian Ethical, purpose. So I'm going to kind of like delve into both meanings of the topic, income with purpose, and taking the income part. We've talked a little bit about the defensive asset choices that you have in a balanced fund, and in fixed income you clearly have the defensive characteristics of relative stability in price. You have the diversification benefits, you have liquidity, and you have income and yield, and I think that is a key differentiator when you're building portfolios where you do need sort of a regular cash flow that you can predict. The other side of things, which has really only been a component, I think, of fixed income markets for the last five years or so, is being able to invest for purpose with the fixed income assets that you hold. And that's really been the growth of the green and sustainable bond market. And I think it's one of the most significant developments in fixed income since securitization, because it really is kind of a new concept and a way to get a sort of a second benefit out of the investments that you make, which is not just the return, but also providing capital with a proviso of how that capital is going to be used, and doing it without sacrificing at all on the returns that you get from holding your fixed income assets. So I might pop forward. I think the first thing we might discuss is a little bit of context. And this always gets people's attention because we're going to look at what the market's thinking about cash and bond yields, and obviously it has a big impact on mortgage rates, so everyone sort of has a little bit of interest in what's going on here. But I think the main thing to point out is that major economies seem to be moving towards a range of 2.5% to 3% cash rates. Some are closer or further along that roll than others, and I think that's going to provide something of a mild tailwind for bonds. But I think one of the things that we have to learn to live with, and for a bond manager I think it's a good thing, is that we're going to continue to have steep curves, because we do have that inflation backdrop which is less benign than it has been for the last few decades. Obviously we had the COVID interruption, the retooling of supply lines, the move towards less globalisation. Now we've got sort of trade protectionism. All these things are quite costly in terms of a backdrop, and therefore mean we're going to have more persistent inflation going forward, therefore higher longer term rates, regardless of whether short term rates continue to come down. And spreads are not super tight for high grade. In fact, there's still quite good value in very high grade credit, but they have got tight for what are traditionally more higher yield credit assets. And I think the combination of those two things gives, for an investment grade manager that's trying to put a diversified portfolio, it does produce some interesting opportunities, because the steepness of the curve and the ability to still get paid relatively well for high grade credit gives you what we call a really nice roll down, because you know, assets in fixed income actually mature, and as they get toward cash, particularly with a steep curve, they get repriced at a lower and lower yield. And that gives you a kind of a capital gain, a persistent capital gain benefit over and above what you might get from just looking at the running yield of a portfolio. In terms of choices in the fixed income market, obviously, and this graphic is a bit stylized, but it gives you an idea of why you're getting high yields as you step out the curve here, from cash into term deposits, into floating rate credit, fixed rate credit, diversified credit, into private credit. And private credit clearly is a very broad church, and can include things that are kind of equivalent to diversified debt or credit portfolio, but also can be much more at the higher risk part of the spectrum. And what we're seeing as we move up this sort of yield spectrum is increasing different kinds of risks. So it might be just purely market risk. You may still be in relatively risk-free assets, but you're getting more mark-to-market because you're having longer maturities and therefore duration risk. Or it might be additional credit risk, or it might be additional liquidity risk, or it might be all of those things. So where does green and sustainable bonds fit into this spectrum? Well, it's represented right across the spectrum, through green and sustainable loans right down to short-term or floating rate green assets, green mortgage-backed securities, for instance. So what do we mean by sort of green and sustainable bonds as a marketplace? It's still relatively new, and I think it's conceptually pretty easy to grasp, but it's a little underappreciated, and there have been some, I guess because it's a new market and it's been developing and maturing, there are still some misconceptions about it. So the first thing to note is that it is a mechanism for issuers to come and to have a structure in place which is agreed by market convention, which has a number of characteristics to it, and will allow a borrower to come to, or an investor to say to a borrower, here is capital for a set period, for a set return, and a proviso of where that capital is going to be applied. And typically, it's applied for some of the most important challenges that we have globally at the moment. So things like addressing the sort of mitigation and adaptation issues around climate change, looking at food and energy security, looking at social housing, so a whole bunch of things that need to be addressed. And there are bonds that have been issued specifically to address those things. What's important about the way that this market is put together is a set of characteristics which allow for a degree of, I guess, oversight and engagement that bond managers typically have never had before. And what I mean by that is that there will be, through the agreed accreditation processes that bond issuers go through, which is set out by the International Capital Market Association, there is a framework which is now become quite well established in markets, and a verification process through entities like the Climate Bond Institute, which allow for a degree of certainty and confidence about the way that these markets operate. And we've also recently seen, in Australia, for instance, the government's working groups around a taxonomy, which looks at what kind of activities are appropriate to go into these kind of securities, and again, give that kind of integrity and confidence to the market. And lastly, it's all around the reporting, because you are going, you have a expectation that these projects and these assets are going to come to fruition. Well, you want to be able to see that reported back to you, and you want to be able to see the impact of that that funding and those projects as they mature. So that's really important about the integrity of the market. Just a little bit about the issuance and so forth. I mean, it's been really interesting. Obviously, globally, there has been a change in the winds with respect to the embracing or otherwise of sustainability as a concept politically and in financial markets. But nonetheless, we are still on track to have another record year of issuance globally for sustainable and green finance, and indeed. Similarly in Australia, we're going to probably approach 50 billion of new issuance in this market for this year, going across all both local and international issuers that come to this market, like the World Bank and ADB and so forth. So again, it is a thriving market. It's making records pretty much every year. It's growing in diversity and choice. Importantly, though, what it does for your portfolio is that it still gives you all of the characteristics and benefits of your typical defensive fixed income allocation. And you do that without necessarily sacrificing return. I think we are potentially going to talk a little bit about greenium, which was a term that went around about particularly early days in the European market in particular, where there was insufficient supply of green bonds, and there was a benefit to those issuers who are early in and supplying that latent demand in terms of lower borrowing costs. But that isn't the case anymore. I think, as I said, engagement and reporting is a real necessity in this sector, because again, there is a certain expectation of the investors into those bonds that they are going to get what they sign up for, and you can't therefore do it on a passive basis. And I think we've obviously seen the damage that greenwashing has done to the sort of reputation of this market, and the degree to which it's really important to have proper integrity and transparency, and it's incumbent on investors like us to maintain the engagement with issuers to make sure that they actually fulfill their obligations. Just give it a bit of a tangible example here. What are the kind of things that get funded for a sustainable bond? Well, looking at the New South Wales Treasury Corp Sustainable Bond Program, that's delivered things like the Metro and our light rail, and they are pieces of infrastructure that I think really move the dial. There are lots of people sort of pretty excited about going for their first ride on the Metro. It was great to see something, that was kind of state of the art and built for sort of an urban environment, and to improve the urban environment, and to kind of address some of the issues that we have as a country. So that's the kind of things that go into this. And I've never, in terms of the normal bonds that I've held over my career, I've never had a connection like that before. I think it was great. My son-in-law sort of come up to me and said, it's really given me sort of cause for hope that we can actually deliver on some of these things that make a difference in people's lives. And I guess the last thing to say, is how does it work in your portfolio? Well, increasingly, there are products out there that are like plug and play. they'll be managed for you so that they effectively are just a traditional bond exposure against a composite bond index, for instance. And the active management risks around that and the construction, is still looking to add value well over what the index is providing. And it's able to do that, particularly as now we have full sector a full sector choice. We didn't have any Commonwealth bonds before the middle of last year. Now we do. That's a real kind of advantage to us as a active manager in terms of doing sector rotation and so forth. And in fact, for us and other managers, it's given us more confidence about the future of this market and allowed us to actually increase the investment expectations or investment objectives on our products. And it's also allowed us to bring down the tracking error to be in line with other active fixed income products. So I think it's very much coming of age, and it's going to be a ongoing, vibrant. I mean, there's some estimations that there's 6 to 10 trillion of finance needed just to do the energy transition globally over the next 10 years. And a lot of it will come through these green bonds. So it's going to be a growing and key component of fixed income markets globally. And I think it's something that will be increasingly either a part of people's portfolios through their conventional funds, or if they want to have more of an impact kind of component towards their portfolios, that they'll go into a specialist fund that has specifically targeting these labelled bonds. I might pause there because I've gone over quite a lot, and we might take some questions.
Bill, all right, now that's definitely working. Okay, you covered quite a lot there. I think it's just important to remind the audience that you can create a core Australian bond diversified portfolio in this sustainable bond, green bond sector. It's not a niche investment. So my first question is actually won't be on the greenium because you sort of covered that, but we might go over it again to remind people what greenium means. It's not just a trendy expression. But on the income side, in terms of the income received by retail investors through distributions in the current market, so talk about actual numbers here, what can reasonably be expected from this sort of diversified portfolio?
Here we go. Look, I think if you look at a diversified fixed income portfolio, like our green bond fund, for instance, it has a running yield of around 4.5%. And that sort of goes up a little, down a little. And that's just the starting point. So you've got the 4.5% there, which makes it sort of maybe a little higher than term deposits, similar. But there are some, as I said, there are some sort of structural things that are available to you in the fixed income market, which make that running yield just the starting point. So if you look at, for instance, the last year interest rates, I think, have bumped up to around an extra 0.25% from where they were previously. So that's actually shaved about 1% in terms of capital return off of that 4.5% that you're getting as a running yield. But if you're invested in credit rather than in government, that's an extra 1 to 1.5%, which offsets that.
So what's the average credit quality?
Yeah, average credit quality is still AA.
Right.
So it's still
above investment grade, right?
Yes, yeah, absolutely, yes. But you also get that roll down, as I talked about before, which is because we've got a steep curve and bonds get older or younger, go to maturity. Then you get about 0.5% out of that. So all in all, if we look at the portfolios that we follow, they've been giving sort of 5 to 6% return consistently over the last 3 years. And that's after fees, and that's giving you an active return of 75 to sort of around 75 basis points, which again is that the target that we have is 0.5 to 1% as an active return.
Right. As the last session reminded us that we're in a volatile world.
Yes.
And one of the challenges that I've observed over many years with Australian fixed interest managers has been their inability to deliver consistent value add through duration management. So what do you think is going to be required, or what are you expecting in terms of the way you run portfolios to deliver that duration return?
Look, we've always had a pretty successful run on our duration management. There are times where it does become more difficult, and I think in particular when governments were pursuing a zero interest rate policy and effectively having a micromanaged bond market by buying through quantitative easing.
Yeah, that period of zero interest rates, that lasted what, 4 or 5 years.
Yeah, it was quite a lot.
And I think there was something like 13 trillion US negative yielding bonds globally, right? So very tough way to manage duration there.
And that what you get in that environment when you're faced as a bond manager with buying and holding an overweight position in bonds as the yield gets to zero and goes negative, you really have to be able to hold your nerve, particularly because you're managing to actually protect the downside for people as well. So I hope we don't see a repeat of that environment, because that is a.
But you wouldn't expect a repeat?
No,
okay.
Absolutely not. In a normalised environment like this, lots of opportunities for bond managers, and I think that is borne out if you look at how well bond managers in general have done over the last 3 years. It's been a good time for active management.
Yeah, although they have had the benefit of a favourable credit environment.
Correct.
Right?
Yeah.
Just on the issue of return to retail/wholesale investors after fees, I mean, as you indicated, a fair degree of skills required in this green sustainable bond area, fixed on top of the normal fixed interest skills that are required. So, are fees expensive? I mean, for managers in this area compared to say, well, we've got these days plenty of, as we heard earlier too, about ETFs and smart indices, etc.
Yes. Well, look, I think it really depends on the I guess the legacy of the product. Some of the older products that were put up were built in a situation where they didn't have scale and they had additional costs, were quite expensive. More latterly, and particularly looking at the range of funds that we manage, they're very competitively priced. And that's because there is scale, and we're able to tap into the ESG and ethics team that services the whole organisation. It isn't all just put on the one product and the one asset class.
Right. And just finally for me, you talked about being more actively engaged with issuers. Like we're talking, the counterparties can be sovereigns or semi-sovereign or whatever, who are quite powerful. How do you ensure they're spending the proceeds the way they've stated in the issues?
Yep. Well, there is verification. I mean, look, I don't think it's usually much of an issue around them meeting the requirements of the specific issue. One of the more difficult things is ensuring that in context, what they're doing with the funds from this one bond issue isn't being blown out of the water by all of the other activities they undertake. So that's something that we need to do. We certainly don't hold every green bond that gets issued, and that goes for both companies and sovereigns, because there are times when their actions make their green bond look like tokenism, in which case we don't want to hold.
That's a good word, tokenism, yes. But we don't want to see that. Just time for a couple of quick questions from the audience.
I have a question, Bill, which is that as we go through the sort of electrification process in the economy, we're going to see a lot of issuance, particularly of debt underpinned by the sort of utility argument. not all of those projects are going to work, and it seems to me there's a good deal of uncertainty about whether the entire, electrification project itself is going to work. Power prices in Beijing, 8 cents a kilowatt hour. Power prices in Sydney, 35 cents a kilowatt hour. This is not a sustainable model. So, long-winded question. How do you assess the sort of long-term viability of some of these projects that are now being brought to market?
Yeah, well, I probably should have made that a little clearer. Green bonds, as they're constructed for wholesale investors like us, don't fund specific projects. So you don't end up with an exposure to a solar farm or a wind farm out west somewhere. You actually are exposed to the issuing entity, which might be a state government, and it has exactly the same credit quality as all of the other state government funding, or it might be through a bank. Quite often the banks will fund a portfolio of projects, get appropriate diversification, and then issue in the bank's name with the bank's credit quality. So you don't have that issue. But I do think, yeah, as you said, electrification is going to be a significant part of the capital call, and it really needs to be. I mean, look at all of the ambitions around data centres globally, and the amount of power that needs to be provided for that, and working as they do on a sort of 3 to 5 year time frame. There isn't any traditional power sources that can be deployed in that kind of time frame. So if they want to power these data centres, it's got to be done through renewables.
Other questions before I ask whether Bill would fund small nuclear reactors? Bill, would you fund small nuclear reactors?
Not currently. Untried technology, yes.
Bill, just we'll go back to the greenium because it's a buzzword that was floating around a few years ago. But I think it relates to this income question, because if there is a greenium, which I get to explain a bit what it is, that would lower running yields,
yes,
and therefore be contradictory to the income objective. If you compared this sort of portfolio against just a regular portfolio that didn't have a green sustainable focus.
Yep.
And if it was significant, then incomes will be a lot lower, right?
Yeah, well, let me put it in context. Initially, and I think where the concept of greenium came was in the sort of early 2000s, when 2020s, when the green bond market in Europe was needing to satisfy a whole bunch of additional ESG focused products, and there was definitely more demand than supply. And there was quite a poorly constructed academic piece which looked at effectively broke up the indices between labelled bonds and non-labelled bonds, and didn't properly control for credit quality and duration, and just looked at the difference in yields and said there's a greenium of 20 odd basis points, which was enormous. When you actually look at paired bonds, so bonds issued of the same maturity by the same entity, there has traditionally only been 1 or 2 basis points difference, if there is a lower margin on the green bond, and that was justified by issuers by saying, well, they have to construct and do all of the reporting, and they have additional costs associated with it. However, that has now disappeared as well. So we look at Copenhagen Business School just put out the very latest research on this at the end of June, and they said they think there's actually a cost to the issuer of issuing green bonds at the moment. So
that's a good point.
Which is good for investors.
Just quickly, the Commonwealth's just, as you said, just commenced their program.
Yes.
What's the scale of that program, and because they've got a lot of debt to finance, right?
Yeah, they do. They have slightly less projects that they can apply to than the states. So the states are still going to be the biggest issuer in this space. But I think the Commonwealth's now got about 10 billion. I expect that they'll continue at that kind of pace,
Right.
5 to 10 billion a year, but they'll grow up their lines. And they've got obviously a role to play in catalysing investment through the Clean Energy Finance Corporation and so forth.
Okay, great. We'll look out for that. Okay, I think our, oh,
No, we might just call it quits.
call it quits.
Okay.
Tea time, I think.
It's tea time.
Okay,
Yes.
thank you very much.
Look, please join with me in thanking Nigel and Bill.